Hello and welcome to this week's episode for Conservative ETF Investor. I'm your host. My name is Ken Cogliano, Senior Market Analyst. And so far, year to date, our model SPY portfolio is down 0.2%. Now, our whole goal here is to beat the return of the buy and hold investor for the S&P 500. Their return is currently down negative 0.95%. So we are accomplishing that goal. Although we're still negative, we're down less. So we are happy about that. We do have a red for the stock market strength color signal. So caution is definitely advised moving forward. Last year, our model portfolio for SPY returned 37.29%. So we're very happy about those returns. Currently, the model portfolio is invested 45% in shares of SPY, and the remainder of that is in cash. Today's video content, this is an intra-month video, so we're going to try to make it as short as possible. This is for retail investors / traders who want to beat the stock market buy and hold investors' returns. We will do a deep dive into technical analysis for the S&P 500. We not only do the technical analysis, but we show you exactly how we trade our model portfolio, and we share with you how we produce our decisions throughout this video. You will hear those tips. I am not sure if there's another YouTuber that is this transparent. Review of last week's trades on the model SPY portfolio equity curve compared against the benchmark against the S&P 500. We're going to look at the bond market, CNN business fear and greed, seasonality, Thinkorswim charts, technical analysis. At the end, we're going to do a market summation, closing thoughts on next trades. So what happened last week? On Friday, the U.S. unemployment report came out. There was a forecast of 155,000. And the actual came out at 256,000. So it was much stronger employment than the forecast. But it's not the news. It's how the market reacts to the news. What did the market do on Friday? Well, if anybody watches the market, they know that on Friday it tanked. We'll go through that in this video. So, and why did it tank? If you had such a good U.S. employment report, there's more jobs created for the U.S. than what they had forecast. Why would the stock market go down with this positive information? The answer is basically summed up to this. The stock market loves easy money. To them, easy money is the Fed cutting rates. They want the Fed to cut rates because it makes money more plentiful and easy in order for businesses and other activities and U.S. prosperity to be more in abundance, let's say. But so with this jobs report and with the Fed, we're having two mandates, unemployment and inflation. Well, obviously, unemployment is a non-issue. But inflation is an issue. So we can't let inflation get out of hand. And if anything, inflation is ticking up rather than ticking down, or at least staying neutral. And it's still too high. It's above 2%. He wants 2% inflation. Him being Jerome Powell, the Fed chair. Okay. So we are going to monitor what the rate is, what the percentage is on the next rate cut or hold. Now, the next Fed announcement is going to be on January 29th. There is a 97.3. It's a little difficult to see the way that they do it here on this Fed Watch tool, but you can see it down here really well. This is now, that was today, the day that I pulled the report. What they're saying is there's a 97.3% probability that the Fed is going to hold interest rates and not make a cut, which is what Wall Street wants. Wall Street wants the cut. Now, just let's see, about a week ago, that was an 89%. So due to this unemployment report that just came out on Friday, basically that's what tipped it over the edge. There's no way you're going to get a rate cut come January 29th on the next Fed announcement. All right. There was another thing that happened on Friday that the market is getting spooked over. And I'm going to show you the full chart later on in this video, but it's the 10-year. So this is a chart for TNX, the 10-year U.S. Treasury yields. Now, I just gave you a snippet here, but basically this right here tells the tale of what it is that I'm trying to show you. This candle, which is Friday's action on the 10-year yields, the Fed controls short-term interest rates. The 10-year is controlled by the open market. The Fed doesn't have direct control over the 10-year. The market does. And the market said on 10-year yields, boom, they shot up. That's going to take things like CDs, money markets, things of this nature, and it's going to make those more attractive with a higher yield compared to putting your money at risk in US or in equities in general. But generally, I'm talking about US equities. So now US investors are going to be deciding, well, rather than put my money at risk in the market, why not just, if I can get a 5% return on a nice solid CD or some good solid money market returns, maybe we'll just take my portfolio of cash. And rather than have the volatility, this is coming off the heels of 2 years back to back with greater than 20% returns. This is 2025, folks. It is expected to be a volatile year. And you got Trump coming in, tariffs, you got a lot of talk, and there's probably going to be a lot of stock market volatility, even without Trump. We're coming off the heels of 20% return years. So there's a higher probability that this is not going to be another 20% return. It's going to be something, and very possibly a negative return. This is going to be a trader's year. 2025, I do not believe is going to be good for the buy and hold investor. I am a trader. As a trader, I am going to be able to hopefully benefit off of long-term trends as I see those trends develop throughout the year. But this is one of the other things that I'm trying to tell you here. The Treasury yields are going up and not down. Not good for U.S. equities. What happened? The yields went up on Friday, and the stock market tanked on Friday. Exact 180-degree opposite. So what happened last week for the S&P 500? By the way, for the indexes we use, when we talk about the indexes, I only just show the ETFs. I don't show the indexes directly. This is a very good representation of what the index did, but we're just showing you the ETFs. Okay, so for SPY, the S&P 500 lost 1.94% for the week. These are weekly numbers right here. For the week, the cubes or the NASDAQ 100 lost 2.20%. And look at this, small caps, IWM, down 3.39% for the week. So if you're a buy and hold investor, you absolutely experienced 100% of all of those losses. All right, here are the trades that we sent out last week. We sent out 2 trade alerts to our subscribers. The first one went out on 1/7/25. Now I might manage 4 portfolios here. I'm only sharing with you guys, the YouTube audience, just one portfolio, the SPY portfolio. Anyway, if you do want to have access to all my portfolios, you need to sign up. There'll be a link for it down in the description down below for you to sign up and become a subscriber. It's a very modest price for the services that I offer. Okay. Now, on January 7th, 2025, in the SPY model portfolio, we're going to sell to open 1 contract. We already had 100 shares that we had purchased earlier in our trading. And I put down the exact strike. We're going to do so this was an in-the-money covered call, basically, because we're going to sell it to open. And we had a 570 strike with a 110.25 short expiration date, okay? And we got paid. $17.95 ka-ching when we made that transaction, okay? Then on 1/10/25, I'm recording this video on 1/11/25, Saturday. So this was just yesterday on Friday's action. Friday, the market sank like a rock. Well, what happened to my in-the-money covered calls when it did that? They became profitable. I'll show you the numbers in the next slide or two. So on 1/10/25, we want to buy to close all of the in-the-money covered calls. So we sold. All right, before we get to that price, here is a 10-day candlestick chart for the S&P 500 daily. These are daily candlesticks, only going back 10 days. So what happened on the 7th? That's this candle right here. Well, we had purchased, we pyramided into the position. We purchased 50 shares, then we added another 50 shares. So here is our original position at putting in 50, then we added 50 at this point in time right there. Then the market was traveling north, but then all of a sudden the market started to travel south. And I was like, you know what? Let's put some protections into place. Let's go ahead and, at that point we had 100 shares, so we could do one contract. Let's go ahead and sell to open one contract, 570. And that was done when the market was trading right there. Then on the very next day, which would be Thursday, the market came up a little bit, but then on Friday sank like a rock. And at this point in time, I sent out the alert to the subscribers and I said, hey, you know what? We're going to buy to close and we are going to now profit. We sold them for $17.95. We bought to close them at $11.01, so we bank the difference. All right, here are those trades for 2025. As I told you, we bought 50 shares, bought 50 shares, shares. Then we did an in-the-money covered call for 100 shares, which is one contract. And at that point in time, we sold at $17.95. We bought at $11.01. Buy low, sell high. What happens? We made a profit, $694 to kick the year off decently good here. We are still negative, but considering that we are beating the buy and hold investor, we're good with that. And we're not even fully invested here, okay? I showed you in the very beginning of this video what the percentages was on how much the portfolio is even invested, because things are not looking rosy right now. This is not a strong bull market by any stretch of the imagination. If you want to learn more about me, you can go ahead and head over to this link right here. It will be down in the description down below. And that is also if you would like to sign up for real-time trade alerts and become a subscriber. I want you to go ahead and smash that like button down, subscribe to this channel, and ring that bell to be notified when I post a new video. All right, now here is our equity curve of our model portfolio, our model SPY portfolio, against the buy and hold investor. So we are blue, they are pink. The whole goal here is for the blue to be above the pink. So anyways, it kind of shows you, yes, we're accomplishing that goal. We are above the pink, so we're beating the returns of the buy and hold investor already just in the beginning of the year. Now we're going to try to maintain that throughout the year, but this is a big blank slate right here. This is the future. This is not 100% known. There are absolutely no guarantees. All we are going to try to do is our best with the information that we have presented to us to make decisions throughout the year to have a good investment return on investment. Okay, so this is a weekly 1-year duration candlestick chart for the S&P 500. We know the S&P lost 1.94% for the week. Now, what do you see in this chart? Let's go through it. This is last week's candle right here. This is the action of last week. Now, the first thing that I notice is that this body of this candle completely envelops the body of the candle prior to that candle. That is not a good candle. That means that there is overwhelming negative energy for the future direction of SPY. Now, if we go back and we look at this 1-year chart, where do you see a body of a candle that's red that completely enveloped the weeks before? You see it there, but that happened at a top. You'll notice this is the top right there. So this candle did not happen at a top. This candle also did it with the prior to the body before. This candle completely enveloped that body of that candle, but again, it also happened at a top. And then the market corrected. And where else do you see that? I'm not really sure if you see that. Well, I guess you could say it kind of happened here. Also not, well, actually you could classify that as a little top, but the way that this candle closed came down and then closed up. I guess I really don't even want to count this candle right there. So let's not count it. We're just going to count this candle, and of course the current candle that we have right now. So right now, the highest probability, just from looking at this chart, is going to be sideways to downward action. That doesn't mean it has to be. It's just what it looks like. Looking at the MACD is below its signal line, heading south. Slow stochastics, below its signal line, heading south. The energy is obviously to the downside. You can see that in this weekly chart. Doesn't mean it has to be. That's just what the chart is telling us. It's like reading the tea leaves. All right, now we're going to look at SPY daily candlestick chart with a 6-month duration. I have got a bunch of information on this here, and we are going to unpack it slowly so that you, the audience, you understand what it is that I'm trying to display on this congested chart. Now, keep in mind that the S&P 500 is the candlestick charts, and the candlesticks, they kind of change color, but hopefully you can see these are candlesticks and these are not candlesticks. These are exponential moving averages and also moving averages. And you can see those moving averages for the 50 in green, the 200 in black. Then you have exponential moving averages. If you don't know the difference between an exponential moving average and a simple moving average, there's probably 1,000 videos on YouTube for you to learn that. So just in case there's a piece of terminology that I'm throwing out there that you don't know, research that on your own outside of this video, because I can't go through every little nuance, what the differences are. This video would take 10,000 years long if I was to do that. Okay. Anyway, so then you have the 8, the 13, and the 21 EMA, and I've got the colors right here, blue, lime green, and red. So when things are healthy, the blue is above the lime green, is above the red, and the candlesticks are above the exponential moving averages and above everything. That means things are strong. When you start coming down and and your exponential moving averages start getting thin and congested together, and then on a worst case scenario, start going upside down like they are right now. Look at this, folks. You have the blue, then the lime green, and the red is on top. That's exactly opposite to the healthy, strong market in which the blue is on top, then green, then red. So we are, instead of us traveling north, we are traveling south. Let me get rid of these arrows. So that's number one. That's one thing that we're looking at. Now, I've got in here in pink support lines. This is the first level of support. Even though we're slightly below it, I'm going to say it's close enough that we are at support right now. We are at the first level of support. So we're at the very, very beginning stages. If this is going to unfold into something really nasty, we're at the beginning stages of it, because it's just the first level of support. This market, any market can fall 5, 10, 15, or 20%, depending upon the market, but it has to start somewhere. So right now, I've got it drawn out here. We're approximately 4.8% off of our highs. We'll just round that out. We're 5% off of the highs. We're at a 5% pullback. Does that mean anything? Is that of consequence? Generally speaking, over the long term, 5% is nothing, okay? It's very common for the market to have 5, 10, 15% pullbacks throughout the year. They go up, they go down. And we're trying to profit as a trader and not a buy and hold investor. We're trying to look for those opportunities, get in the bottom, buy low, and sell high. And then depending upon what we see, when we have a high opportunity and we have shares, well, maybe I'll do an in-the-money covered call. And then as the market drops, such as it just did last week, and I see that in-the-money covered call going positive, going profitable, I should say, I say, you know what, let's buy to close it. We're going to make some bankroll. Let's put that money into our pockets. So that's how there's several ways that you can benefit off of these rolling hills, or the movement of the market, so to speak. You can see right here, the market comes down, it goes up, comes down, goes up, comes down, goes up. So you're just trying to make profit while you see these types of rolling hill activity happening. You're just trying to position yourself so that if the suspected move happens, you're in a position to profit from it. That's the goal of what it is as a trader that you're trying to do. Now, let's continue to go and unpack what we're looking at here. Second level of support is this one based off of that low right there. Third level of support is that pink one right there. Now, I have drawn in here a rising wedge. That's this one and this one. So I know the two don't touch, but you can see that that's a wedge formation. So it's a rising wedge pattern. And I was looking for a breakdown. And a breakdown means that you're going to come below this support line. We did do that right there. You'll notice this red line that I have drawn in here. That red line is this exact same red line taken from the rising wedge pattern from the upper resistance to the lower support line. That line was carried over. So when we breached the support, I brought that in to put that down as a potential low. Look what happened on Friday's action. This is a daily chart. These are daily candlesticks. On Friday's action, did we exactly tag that lower end of the projected move based off of this rising wedge pattern? We absolutely 100% nailed it. And look at the action. The market came down, tagged it, and actually bounced and started to go up. Not much, albeit not by much, but it is very possible that this blue line that I'm pointing to right now is going to be a level of support, and this market is going to advance to possibly this line. What is that line? Now let's look at that next. You'll see this high. You'll see a high here, which is a lower high. You'll see a high here, again, a lower high. Lower highs and lower lows is the definition of the trend traveling south. And that is exactly what is happening. You have lower highs, but you really don't have lower lows. Kind of. This one here on Friday's action technically is a lower low, but it's so close, I'm going to say that it's almost flat. So, but still, it's not healthy. Healthy would be higher highs and higher lows. You're absolutely making lower highs. You can clearly see lower highs. So I drew a trend line in based off of those highs. That's this line right here. That's going to be the first level of resistance that if we're going to start to bounce from here, that's going to be the first trend line that we're going to hit. That's going to act as a level of resistance. A lot of these trading that goes on today is done with not humans, but with bots. And the bots, they know all of this stuff in a microsecond. So it's very possible that you're going to see us come up, just completely kiss that, and then start coming down. We could be very strongly in right now what I'm going to call the dead cat bounce territory. We are negative. You can see on the MACD here how south everything has gone, very negative. Slow stochastics below its signal line, getting ready to go below 20, all negative. All right. We know that our exponential moving averages are upside down, negative, bearish, all bearish. All right. In addition to that, I was contemplating, I have cycle brackets drawn here at the bottom. This low is obviously that one. That one is that one. That one is that one. That one is that one. Very obvious. This one I was a little unclear of, but I think now that this one is that low right there. If that's true on this cycle, that means that we had an immediate breakdown. Left-hand translation, negative bearish activity, not good. In other words, you really don't want to buy the dips and sell the rips. You really want to short the highs. So the shorting activities, I wasn't really sure till now. I feel more comfortable saying that that is now that low. I suspected it, but I wasn't 100% sure. I thought it might be this one or something like that. But I needed to see a little bit more. But the way this is unfolding, it looks like that was the low, and that this is a left-hand translation, and we're getting immediate breakdowns. We're getting lower highs. Now here, we didn't make a lower low. We made an equal low, and when it tried to make the advance, it got stopped right at that exact trend line that I talked about and started to come down, and technically has made a lower low. But because we're at this level of support from this rising wedge pattern, I would not be surprised to see up next week to be a positive week. I would not be surprised for it to be a positive week. Is that a guarantee? No, it's what I suspect. All right, now we're going to look at the VIX, Volatility Fear Index. That is the candlesticks. These are the candlesticks right here. I also have 3 levels. Above the green line is the upper range bearish. Below the green line and above this green line is a low range, which is still bullish. Below this green line is the ultra low range, which is again bullish. Where are we? We are below the green line here, which takes you from the upper range bearish to the lower range bullish, but we're very, very close. Now, if you see the candle came up, tried to go higher, but got rejected and pushed back down into the low range. Well, when you're in the low range, the market can move forward. It's still bullish. This number is below 20. 20 is the magic number, folks. If you're below 20 on the VIX, generally speaking, the market can move higher. It has a higher probability of moving higher. Now, a couple negative things here. The MACD is above its signal line. It looks like it's traveling north. And the slow stochastic's above its signal line, and it looks like it's traveling north. Keep in mind, when the VIX travels north, the S&P 500 travels south. So keep that in mind. Now, I do have the S&P 500 drawn in this blue line right here, and I put in a trend line based off of these lows and approximately these lows right here. And you can see that we are now below this trend line. Not good. So we're basically losing the market is kind of like what's happening here. So defense is definitely, your cautionary flags should be up right now, because the S&P 500 is certainly not in a strong bull market. Even though we're close to the highs, we're only off the highs by like 5%. It looks like 2025 is going to be a year in which we're going to want to be shorting those highs that I talked about. I think we're at a support level now. I don't want to go short the market right now, but eventually I will want to go short the market based off of the information that I'm seeing. Let's continue on with this video. I hope you're enjoying it. Smash that like button down for me right now if you haven't done so already. All right, here's the full chart for TNX, 10-year U.S. Treasury yields. Folks, I know this is possibly a boring chart because, who wants to talk about Treasury yields? This is what is dictating what is happening to the market. The 10-year yields on U.S. Treasuries is very, very important, because the stock market is going to base how it reacts based off of what this market, the 10-year yields, are doing. All right, so it's a 1-year duration candlestick chart. I've got SPY in blue and TLT, 20-year bonds ETF, in black. And you'll notice this is the black TLT line here. When the yields travel north, TLT travels south, 100% opposite. All right, so keep that in mind. What is happening? We are making new highs, like I spoke earlier in the video, on the 10-year yields, TNX. Look at the MACD. MACD is above its signal line. It reached a high, started to come down, did not breach its signal line, bounced up on top of it, and is traveling north. You can see it here in the thumbnail really well. It's traveling north. That means that the probabilities of TNX traveling north more is very high. We have not seen the end of higher highs, making new all-time one-year highs. This is a one-year chart for TNX. Usually new highs begets new highs. We just made a new high. And even if TNX is to back off a little bit, the probabilities are higher that it's going to continue to make new highs. Continue to want to take that money from investors that are going into equities and put them into safe products such as CDs, money market, things of this nature, things where your money is not at risk. So this is definitely going to be in competition for U.S. equity funds, investing funds. All right, now we want to look at the bond market. The bond market is 3 times the size of the stock market. I just pulled this up. This is all fresh data for the 91 2-year and 10-year. We have a normal yield curve, and I've got the numbers right here, got backdated history right here. We were inverted for about 2 years. We are no longer inverted. We have a normal yield curve, but you have rising interest rates. 1 year ago, the 10-year, 3.95. 10-year, today, 4.76. That's a rising interest rate environment. Generally speaking, when it comes to investing, should you be in the market or out of the market? When it comes to the bond, in relationship to looking at bond yields, you should be out of the market. All right, here is our friend, Mr. Warren Buffett, the Oracle of Omaha, and over here is CNN Fear and Greed Index. We want to compare the current reading, 27, to 1 week ago, 33. So where is 33 here? 33 is about there. Well, we are going towards extreme fear in this market. We're not at that yet, but we're pretty darn close to extreme fear. And of course, Mr. Warren Buffett says it the best: be fearful when others are greedy, and be greedy when others are fearful. Others are fearful right now. Now's the time to be a little greedy. All right, now we're going to look at seasonality. This is a 5-year duration. We are in the month of January 2025. There is a 40% probability that you're going to close higher than when you opened. So what does that mean? There's a 60% probability you're going to close lower. Well, guess what? This is a monthly candlestick chart for SPY. For the month, SPY is down 0.95%. We're already down for the month. We've accomplished that goal. We're within the highest probability of being negative. Today's the 11th. There's still weeks of trading before this month is over. So we're going to see some volatility. I want to show you this. Look at this. This is a monthly candlestick chart. Duration's about a year. Yeah, it's a 1-year duration. I've got in here resistance and support and support. So a couple different support lines. Well, obviously we're trading below this support line here. You can see where it's drawn from. But look at this other support line. We are right sitting on it. It's very possible that this support line is going to hold, and we are going to bounce up from here. Not a guarantee, but we are at a support line. It could absolutely act as support. We could bounce off of it. Not a guarantee. We could slice through it and come down. Okay, we are on the Think or Swim platform. 3-year weekly chart for SPY. We have a standard deviations, +2, -2 in gold, +1, -1 in pink, the halfway regression line in the dashed green. What do you see happening here? You can see the rising wedge pattern that I talked about earlier in this video. You can see the breach falling down from that support, and you can see this this is a little bit different chart because this one's a weekly. The other one was a daily. On this chart, on this rising wedge pattern, you'll see the high and the low taken from this dotted line here. That's this same dotted line here. We breached right here. We have a possible low that we could hit coming in somewhere around 540. So we could drop down right now as low as 540. That is a possibility. You can see the candle that we have. We talked about that, and the body and how we're overshadowing that body right now. I think that we're in bounce mode right now, but judging just based off of what you're seeing in this here, it looks like we have more sideways to negative action happening. Let's switch over and let's look at a daily chart. We're going to go to a 1 year daily and change our cycle brackets to 1 year daily. And what do we have here? Let's just check this out. Now, you can see I've got 3 alerts that are automatically going to talk to me if something happens. And I've got this alert here. I'll be honest with you. This alert is the most important alert to me because I've drawn in a trend line right here. And let me show you exactly how I did that, folks. Just in case you guys want to do it. I'm going to get rid of that. See that trend here? I'll tell you what, I'll even just remove that trend line. I want to put a trend line in right there. So I got my drawing tools. I'm going to go to this trend line here. I'm going to grab something like, let's see, I want to grab something like this. I want to come down and grab, I kind of like this, but I want to move that a little bit. So let me activate that, and so I took that angle, but I'm kind of moving this a little bit. So I'm a little bit off, but at that same angle that I kind of liked, right about there. It's not quite the highs, but it's close enough for me, okay? Now that I've got that, I'm going to go ahead and right click, and I'm going to do create alert withdrawing, and I want to know when this crosses above, and I'm going to hit create. I just created that alert. My cell phone is going to ping once this market comes up north and breaches that. To me, that's a breakout. Things are moving north, not south. That would be good. That's when you want to put money to work, or more money to work if you're not fully invested. I'm not currently fully invested. So if I start seeing this thing breach this trend line right here, I would like to potentially take on some more shares, put some more money to work. So your money is like soldiers. And right now you've got 50% of your soldiers just sitting there in the barracks waiting to be told what to do. So if we want them to sit there and just wait for action, but once you see something like this, you see that the market is now breaching these resistance lines. Well, now I want to take those soldiers and I want to put them to work. I want them out on the battlefield, and I want them ready to contend and do battle for me and work for me, okay? So that's kind of like where my head is at and how I look at this whole trading thing. What else do you got going on right here? We do have our cycle brackets down at the bottom. Now you have the major and the minors. You can see that's a low and that's a low, and you can kind of see how that low lines up with that one and that one lines up with that one. So it looks like you've got one major cycle and 3 minor cycles in between everything else. This is the clearest one. They're not always clean. So take all of that. You know, this is just a drawing tool. Nothing's a guarantee here, folks. And then I also kind of make a note of what's positive and neutral, and if there's a negative cycle, I want to kind of know that too. So I kind of put my own little notes in there to see what's going on. Right now, the market is clearly messy. Let me just get rid of that so you can see that. Look how messy this is. So rather than this clean upward trajectory, Now you kind of see this messy sideways to downwards trajectory happening right now. So things are just not as rosy as we want them to be. Let's go ahead and look at QQQ, and let's go ahead and look at the daily chart for QQQ. See, I've got my alerts set up in there, kind of like the same thing, a little bit of messy action going back and forth here. Your MACD down here, your slow stochastics up here, not looking good. Looks like we're going to come down, possibly tag this lower support trend line here on QQQ. Let's look at IWM. And we've got daily, and let's just switch this one to daily. Now on the daily brackets here, let me get rid of that for a moment. You're moving sideways to now down, and now it looks like you are in this downward trading channel. So what you really want is I want to get the breakout above here. So if I want to put more money to work here, I'm going to create the alert on this one right here. Oh, hold on a minute. Do that one more time. I want to create the alert with the drawing. I want it when it crosses above. Make sure it says crosses above. And then as this breaks out, I'll be alerted, and then there'll be plenty of opportunity to grab that trend and make some money. But until you break out, you're still in this downward trajectory here. So caution is advised. You are closer to the bottom of the trend line here than you are to the top of the trend line here. So eventually we should be close to a level of support. We may have already hit it. This black line here is a 200-day moving average. Look at Friday's action on IWM. Came down, practically kissed, you might as well call it, it kissed the 200-day, bounced, got rejected off of it, and then came up. Still, it's a red candle. Still, it's a negative day. Look at the day. Lost 2.2% on Friday. Terrible day. One day for an index down 2.2%. But it looks like we did bounce off the 200-day. We also have the standard deviations, -2, right? Excuse me, -1 is right there. We are right. We did get below the -1 standard deviation, and now we're still below it, but we're very close to it. There's a 68% probability that you're going to stay within one standard deviation. So there's a higher probability that you're going to be traveling north in the short term than south. Not a guarantee, just a probability. Okay, folks, now we are getting to an Excel spreadsheet that I created in an effort to determine the health of various asset classes and the 11 S&P 500 sectors. The best number you can get after doing all the math here, over here in this column, is a 6. Anything with a 5 or a 6, I give it the color green. Bottom line, the more green on the screen, the healthier things are at. Well, folks, I'm looking at this chart here, and I only see one asset class in green, and that is gold. Gold is the only thing right now that is shining. Every other asset class is not strong, not looking good. So that means, and that's why you've got red for your asset classes, and you have red for the 11 S&P 500 sectors. Now, we want to compare the current reading, this is for asset classes, of 7 to last week's reading, 13. What does that tell you? We're still getting further weakness is still showing up in these charts. 7%. You think we are like at rock bottom here, okay? Down below in the 11 S&P 500 sectors, last week, 29. This week, 6. Obviously, things are heading south in a fast hurry. So you definitely want to put caution. This is where the buy and hold investor doesn't have any opportunities here. You know, things are heading south. They're buy and hold people. What do? They just buy and hold and hope. That's not me. That's not my trading style. But you can see that things are definitely not strong. Okay, another thing about Warren Buffett, I just want to let you know that he's the head guy over at Berkshire. I guess they don't call it Berkshire Hathaways anymore. I think I think it is Berkshire Hathaway Conglomerate. Okay, here they just use the term Berkshires. Anyways, he's 28% in cash. That's Mr. Warren Buffett himself, the man, okay? He's 28% in cash. Not a bad thing for us to at least be 28% in cash during this time frame. Okay, that is going to take us to the end of this video. January 11th, 2025, the market summation, according to me, Ken Cogliano, senior market analyst, your friendly host for Conservative ETF Investor. The market is deteriorating as noted by the red on the strength signal. You can see it here. This is not the first week that I'm telling you this. You go back and look at my videos. I don't know how long I've been saying the market is deteriorating. I've been announcing this, okay? We are so low on my Excel spreadsheet that I'm looking for a dead cat bounce. I showed you how low the numbers were just a couple slides ago. This market is so weak and we are not fully invested currently. I showed you that at the beginning of the video. I want to share with you this quote by John Maynard Keynes, famous quote. Markets can remain irrational longer than you can remain solvent. That particular quote came out during the 1930s, back then when the market was in the strong bull market and it looked like everything was just rosy. Everybody was happy. And then when the market started to correct, the people couldn't believe it. They were like, oh, we're going to continue to buy. We got to continue to buy. The prices are dropping down. It's more of a buy than it is a sell because it's only going to go up again. That was the thought process. Then that's when the Great Depression took hold. And what happened? The markets can remain irrational longer than you can remain solvent. And it wiped out a boatload of people back during that time frame. That's not going to happen to us because that's definitely not my mentality. If you're watching this channel, that is not going to happen to our portfolios. Okay, so last year was a great year, 37% compared to the buy and hold investors, 25%. We smoked them by 14%. You want to learn more about me? You can head over to my link. It will be down in the description down below. I hope you got some valuable information out of this video. If you have not done so already, smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.